Welcome to a new episode, Deep Dive with today Jeff Snider. Jeff is the head of global research of Alhambra Investments and considered one of the few experts on the Euro-Dollar system. Basically, all we know about the Euro-Dollar system, Florian and I, we both learned it through his content. So it's a huge honor having you on the show today. Hi, Jeff.
Good morning. Well, it's good morning for me. Good afternoon for you guys. Thank you for having me. It's a pleasure to be here.
Yeah, thank you very much. We thank you for your time. And I believe it's the first time for you on a German channel. And we're very honored having you introduce it to the German audience in Austria, Switzerland, Liechtenstein, and of course in Germany. And hey, Jeff Snider, the name, it says already you have German ancestors. So do you speak any German?
I don't. I should, though, because you're right. I do. Both sides of my family, I have deep affection and deep appreciation for Germany. I mean, that's where my roots extend far back, as far as we can tell. So soft spot in my heart. I can't believe this is the first time I'm in Germany. So, I'm glad you guys gave me the opportunity to rectify what is a huge hole. We got to get the Euro-Dollar story into the German consciousness.
Exactly, because we are actually the main attributed to the Euro system and we will lose the most. So that's why it's so important to understand this whole system. So this show is called Financial Intelligence. And oh boy, you're going to teach us some serious financial intelligence today. I can promise this. So definitely stay on the show, subscribe, hit the button and follow us. And I'm super excited as well as Florian, because he's a huge fan of yours. And you're one of the few macro thinkers out there who are really challenging and questioning the whole inflation narrative. Because I'm an inflationist. Florian is sometimes inflationist, sometimes deflationist, but we talk about this today. Perhaps you can persuade me or something. And in your opinion, we should worry about deflation instead of inflation. So, and before we get into this, I believe everything starts with the Euro-Dollar system. I assume 95% or 99% of our listeners never heard of the Euro-Dollar system. So please explain it to us, Jeff.
Well, it's a complicated subject, but the brief overview is that there is a monetary system that exists in sort of a regulatory, even national black space, which is offshore of not just the United States, but offshore pretty much everywhere. And it's a bank-centered monetary system, which simply means that banks trade liabilities and assets back and forth where there's no currency involved. It's a monetary system without money, for example. It's simply a ledger-based system where banks kind of balance their books on a daily basis outside the regulatory boundaries of most major, pretty much any major countries anywhere. And so we call it the Euro-Dollar system because the term Euro-Dollar used to be referring to a specific case of U.S. dollars that were on deposit outside the United States, mostly in Europe, mostly in London, actually. That's where the term euro came from. So let's be perfectly clear from the start. This has nothing to do with the euro, the European common currency. The term long predates that. We're going back into the 1950s and 1960s now, where it simply means, where you see the term euro and then a currency, that just means offshore currency. So if you see euro dollar, that's offshore dollars, bank-centered dollars. There's also euro yen, euro yuan, and even euro euros. So it's, euro just means offshore. And that offshore seems like, it's kind of a trivial sort of term, but it's everything that really matters to the global monetary system is because it is offshore, because it's bank-centered. And therefore, that kind of leads into all these other, the history of how we got here, housing bubbles, asset bubbles, those kind of things, the 2008 crash, and then what has happened ever since then. It all goes back to this offshore monetary system.
So basically, a euro dollar is a US dollar that's created outside of the United States of America. Is that a quick summary for somebody who doesn't know what a euro dollar actually is?
Yeah, it's and it gets really complicated real quick because it doesn't have to be created outside the United States, and it could be created outside the United States and end up inside the United States. So it's not a one or the other where there's an offshore monetary system separate and distinct from a domestic US dollar system. There's simply a global US dollar system that by and large operates offshore and then has all of these very intricate, very interesting, very complicated connections to national currency systems all over the world. And the reason it's important is because as a global reserve currency, every other national system has to have a connection to it. Otherwise, you can't engage in global transactions, whether they be merchandise transactions from trade or whether it's, financial flows, for example. everything gets mediated through the US dollar reserve system. So that system essentially is the center of the global monetary world. Even if it's offshore, it has very direct and very substantial impacts with national systems all over the world, not just those in US dollars, but other currencies as well.
So let's summarize. So every private bank can create actually dollars, can print dollars even outside the US and send them back and use them. And yeah, so every bank actually.
I wouldn't say every. It's sort of a exclusive club where the largest banks who engage in these Euro-dollar networks, and they're not just hard. I mean, most of them are just ad hoc networks based on short-term usage. But banks that are connected to the system and are acknowledged as connected to the system have the ability to manage their own balance sheets, and those balance sheets, because they're connected to their system, are accepted as essentially a virtual form of currency. If I say I have US dollars and I'm a bank connected to the system and you need US dollars, I'm going to lend them to you even though there's no US dollars involved. You've created a liability where you owe me US dollars, and I've created an asset where I've loaned you US dollars, and that's really all that happens. We've essentially created US dollars from nothing more than balance sheet mechanics. And it works because we both agree that we're connected to the Euro-dollar system, and therefore we think US dollars. They're not really US dollars, though. That's the important point. They're just bank, you have a bank liability, I have a bank asset, and it works. There's no currency exchange. There's no paper Federal Reserve notes going back and forth. There's no gold. There's no money. It's simply a virtual ledger system.
Which banks? Is there a list of banks like in Germany or in France? Which banks are allowed to do this business?
There's no list. That's part of being offshore, is that you don't have to be officially approved to do this stuff. You just have to be accepted by everybody else. Like if I went offshore tomorrow and I set up a bank in the Cayman Islands and started, I hung out a shingle and said, I have US dollars.
Nobody cares.
Nobody's going to do it, right? They're going to, what the hell's going on with this guy? No. So if the rest of the bank, if you're an established bank in, say, Switzerland or someplace else, and you set up a shingle in Liechtenstein and say, I have US dollars, the banking system is going to say, yes, I accept the fact that you claim that you have US dollars. And the reason is because you can say that, well, I can connect to the Euro-dollar market, and if I don't have US dollars, I can borrow them from another bank who claims that they do, that you all accept. So it's like an exclusive club where there's no specific hard and fast rules. It's really about almost sort of, it's reputation is part of it, but most of all, it's just whether or not you have the same sorts of capacities and capabilities that are acknowledged by the rest of the system.
Do we have any numbers how big the Euro-dollar system is, or is it basically like a shadow banking system and nobody has a clue how big it is and what's really going on, and every bank is basically doing its own business, but without any overview?
That's, in the term shadow banking really refers to what we're talking about here, which is shadow money. And you're right, Florian, there's absolutely, we don't really have any idea of how big it is or how extensive it is, because for a very long time, nobody paid attention to this because it was offshore and everybody focused on their own game. The Federal Reserve was only focused on what's going on inside the United States, even as this massive monetary expansion took place, especially in the 80s and 90s and middle 2000s, outside the United States. So nobody's been paying attention. For most part, this Euro-dollar system is unofficially unacknowledged. It doesn't exist because it would blow up the existing monetary paradigm. It would blow up existing econometric models. It would basically undermine everything that we've been taught and told about how things work. Because of that, there's no monetary scholarship that gives us a sense of not only how big it is, but what really goes on in these places. And I'll give you a specific example, like in the repo market. People are starting to pay attention to repo, and they realize it's an important part of the monetary system because it's a key factor for liquidity in the Euro-dollar system. Now, most of repo, you see repo statistics thrown around about, how big is the US dollar repo market? It's several trillion, or, it's 10 trillion or whatever. That's really what we can see. By the majority of what goes on in repo is simply, as we just did between me and Mark, it's an exchange between two banks that never hits the tape, never hits any data, it never shows up anywhere. So most of repo, for example, is bilateral bespoke, which means it's just two banks transacting on a single day that nobody will ever know about because there's no reporting requirements for it. And we can window dress our balance sheets at the end of the quarter so we don't have to report all these other things. So we don't really know how big this thing is nor do we really know it's all of its various intricacies and forms, because it's not just repo, it's not just unsecured lending. There's all sorts of derivative contracts that work in exactly the same way as debt and money do. A currency swap, for example, functions every bit the same on a bank balance sheet as if I actually lent physical dollars to Mark. So it's incredibly complicated. It's unknown. It's huge, and all of this stuff is mostly unexplored.
Yeah. So a lot of people actually believe that the dollar is dying and we are on the road to hyperinflation. But you would actually argue that the dollar is not dying. We're seeing actually the opposite. So you say we have a shortage on dollars and we need even more dollars. Please elaborate.
Yeah, I would actually say the dollar is dying, but the symptom of it's a fatal disease is what you just described. There's not enough dollars, not too many. Look, most people's perception of the US dollar goes to the Federal Reserve's balance sheet. The Fed is printing money, quantitative easing, trillions in bank reserves. Well, the Euro-Dollar system has very little use for bank reserves. So what the Federal Reserve actually does isn't really functional money for that system. So the Fed is simply spinning its wheels, trying to fool people into believing it's accommodative and easy liquidity money policy, when in point of fact, in effective money, in effective euro dollars, every single bit of evidence says there is a shortage. And not just a shortage now, there's been a shortage since August 9th of 2007. So we're going on 14 years, almost exactly 14 years since we've had this shortage show up. And again, as I said, it's not just one thing or another, it's actually everything. And that's the reason why, for example, the Federal Reserve has to repeat doing QEs, because it doesn't actually print any money. It doesn't get into the actual monetary system. And same as why is the European Central Bank has to repeat QEs? Because in a bank-driven monetary system, if the banks aren't creating money, it doesn't matter what the central bank does. Other than, maybe some temporary sentimental effects from QE, but QE is not money printing. And when you realize that fact, then you start to see how all of the rest of the stuff actually makes sense. And I'm going to start with interest rates, for example. People are puzzled by the fact that interest rates are low and only going lower. And they try to attribute that and ascribe that to, well, central banks are buying bonds, they're printing money. It's the everything bubble. You hear that term thrown around, or something like that. No, low interest rates, historically speaking, have always corresponded with tight money conditions, not loose money conditions. Think about the United States in the 1930s, the Great Depression. That's a period nobody would confuse with an inflationary period, right? Absolute deflation. What did interest rates do in the 1930s in the United States and around much of the rest of the world? They went lower and lower and lower, tight money. Conversely, you go to the 1970s, the Great Inflation. What were interest rates doing in the Great Inflation? Up and up and up and up. So right from the very beginning, we've been taught everything backwards. We've taught low money equals stimulus. We taught the Fed prints money. It has a printing press, when both of those things are not true. And so I can understand, and I even sympathize with people who think, well, the Fed's ruining the dollar. The dollar's going to crash because the Fed's going into overdrive. And I tell them, no, you need to step back and look at all of the evidence, look at all the history. And what it shows you uniformly is that we did have a lot of dollars up until August of 2007. But since then, it's been a dollar shortage. And that's the underlying deflationary structure, which begins to explain how the world actually is the way it is, why there has never been inflation over the last 14 years, even though time and time again we keep hearing, oh, inflation is going to hyperinflation, all this stuff. It's not the dollar's going to crash. We keep hearing that every couple of years, and it never happens.
But Jeff, help me out there. If you actually argue, okay, there's no inflation, QE isn't actually money printing, we don't have everything bubble or credit bubble. If I look at the real estate market, and it doesn't matter if it's in Germany or the US, if I look at the stock market, if I look at the art market, even if I look at Pokemon cards and all that baseball cards, they seem all to be in a hyper bubble. So is this view wrong? Is there an asset price inflation, or how do you actually connect those different views and angles?
There absolutely is an asset inflation component to it, but it's not a monetary component. It's a sentimental component. Look, in any economy, even the worst economy, people who are doing well are always going to be doing well. And they believe that the Federal Reserve is printing money. They act on that impulse, which is exactly what the Federal Reserve or the ECB wants. They want you to believe they're printing money because then you'll go out and act like they are. And that's what we see happening in asset markets, but there's no money involved in it. It's basically, I hate to say, to use to get into it, but rich people have been buying assets because rich people have money to begin with. Where we get into the problem, where we get into talking about inequality, is that this fictional money printing doesn't help the rest of the economy. So anybody who's been buying stocks, they're doing really well. But that's not a money issue. That's a psychological issue. In quantitative easing is a perfect example of what the Federal Reserve actually does, which is expectations management, not monetary policy. And if you want to, indulge me here for a couple of minutes, I'll back up and get into some of the history of this. Back in the 50s and 60s, when all this monetary evolution really began, the Federal Reserve and all the central banks around the world realized they could not keep up with what banks were doing in monetary forms. Repo was one example. The early currency derivative markets, for example, those things started to develop, and central banks started to throw up their hands like, we can't define money. What are we supposed to do? We're a central bank. We do monetary policy, but we can't even define money, let alone track it. What they came up with was the idea that, well, we don't have to track money. We don't have to really understand what the banks are doing with money, because we'll just control the banking system. In other words, we'll signal to banks what we want them to do, and they'll take care of the details. That's where you get into interest rate targeting, for example. So in the United States, the Federal Reserve would raise or lower the federal funds rate, not through actual money. There was no real open market operations involved here. It was simply to tell the banking system, we want you to tighten credit. So we're going to raise the federal funds target, and we expect that you guys are going to work out the monetary details that will lead to a tightening situation. Didn't really work that well, but they convinced themselves it did, enough so that they convinced the public that's what happened. And this was the great moderation of the 90s and 2000s, which we're supposed to believe was in large part due to this expert use of monetary policy. Don't fight the Fed. Alan Greenspan, the maestro, all this stuff. But none of it was actually true. What really happened was this monetary evolution in the offshore spaces went into overdrive. And so that's really how we explain this globalization trend over the last couple decades of the 20th century and the first couple decades of the 21st century. But by and large, central banks rode the coattails of the Euro-Dollar system's growing ascendancy and then took credit for it. And you don't have to take my word for it. There's any number of central bank scholarship that will tell you this is exactly what happened. It's an expectations-based policy. Now, how does that work vis-a-vis the stock market? Well, if you believe that the Fed actually prints money, whether it does or not, you will act as if the Fed has printed money. And believe me, in the financial services industry, everybody wants to buy stocks because their fees go up. We get paid more when stocks go up. So we're already itching to buy stocks. Now, there are times when that's troubling because people take a look around and say stocks are overvalued and things are starting to look shaky. Why are we buying stocks? If I'm a portfolio or fund manager and I can call my clients or my mandate, the people in charge of the mandate, and say, well, Jay Powell's got me covered. He's doing QE. I can buy stocks. There's no risk. And as long as everybody believes that, guess what happens to stock prices? They go up, even if it has no bearing and relationship on the real economy, which exactly explains where we are in the stock market. The stock market has gone insane, completely detached from conditions in the real economy because there's no money in it. It's all an illusion. And as long as people buy that illusion that the Federal Reserve is powerful, they're buying stocks, they're buying art, they're buying NFTs, they're buying all sorts of things. But guess who's not buying those things? Everybody who's harmed by the real economy, which over the last 14 years has been a larger and larger proportion, which explains not only why the stock market's gone to the moon, but at the same time, we have social, political fragmentation and upset all over the world because we have this primary money problem, which is a shortage nobody understands, which means nobody has any good explanation for what's really going on here. So you can it's a really confusing situation where you have all sorts of contradictory signals if you cannot interpret them in a realistic worldview. And that's where we get back to the Euro-Dollar system, what central banks actually are. We start to understand why these things are doing what they're doing, because it's kind of the opposite of what we've been told and what we've been taught. And as I said before, when you do that, when you change your worldview to the what I'm saying is the proper perspective, proper monetary perspective, at least, these things start to fall in line and you can start to see what's really going on.
But Jeff, if we look at the CPI, for example, CPI inflation, or if we even look at the shadow stats, we see numbers above 10% inflation. So should we not worried about it?
Well, let's define our terms here. Let's talk about what is inflation, and that's another point of confusion and contention, because when we're talking about inflation, textbook inflation is a monetary phenomenon. It's always and everywhere a monetary phenomenon. Inflation is, the old term, too much money chasing too few goods, right? So, but inflation isn't just the fact that some prices might go up for a couple months or whatever. Inflation means a sustained, broad-based increase in consumer prices. So if you go back to the 1970s, you had a 15-year period where it wasn't just one price or another that went up, or one bucket or one price, consumer price class or another. It was everything that went up for year after year after year after year. That's inflation. What we're seeing right now looks like inflation, but it's only a short run period so far. And I know people are going to argue it's going to continue. I would say that the bond market says no chance. But anyway, it's certainly been, yes, we have high levels of CPI, but it's only been for a couple months, and it's very narrowly construed. It's not like it's all prices are going up at that rate. It's actually been funneled into a narrow amount of prices. And the reason is it's not a monetary reason. It's simply supply demand factors, supply bottlenecks, and all these other things. That's not textbook inflation. Yes, it is consumer prices going up, but it's not the inflationary. It's not caused by too much money. It's not caused by that kind of a economic situation. It's not even caused by, economies operating at or above potential. It's simply supply and demand factors that are way out of whack, which can cause temporary price deviations. This is not an unprecedented situation. In fact, it happens fairly regularly. And what we're really worried about, and what we really want to know, is whether or not this continues for a prolonged period of time. And so when you look at forward-looking signals, even in the CPIs themselves, when you see them narrowly construed, you see them as a result of supply factors, you're already thinking this isn't really inflation.
Okay, Jeff, there's so much to unpack here. And let's start. Okay, let's assume you're right. And I think you're right about money printing, or QE is actually not money printing. It's just printing bank reserves. But what about governments? I think there's a different ballgame, especially over the past 16 to 24 months, where actually governments started to hand out checks so basically helicopter money. So they're handing out money to people. Now in the US, there's this big infrastructure bill with insane money spending. So they're actually flooding the world with money. So and in this case, I think it's really printing money. So if the government starts a huge infrastructure bill, it's actually like printing money. So that's different if the Fed is actually trying to print money. So do you see
I would not call it flooding the world with money. I would definitely not call it printing money, but you're right. That is definitely different in the developed world outside of Japan over the last, since last year. In the United States, the federal government has gone completely insane. It's completely lost its mind. However, this is not unprecedented either. The Japanese did the same thing in the 1990s. And guess what the result was? It was not inflation. It was not Japan flooded with money. In fact, it was deflationary. So we can get into the reasons why, but historically speaking, large government programs that happen, the New Deal, for example, large government programs that take place during periods of deflationary money do not change the situation of deflationary money. They're simply responding to that situation without the ability to change the situation, or at least any of the underlying fundamentals. So in one sense, what governments are doing, they're simply trying to fill up a huge monetary hole that already exists. And that's really what nobody seems to want to factor, is that, wait a minute, we're in a deflationary hole, and it's not like the government is piling money on top of a healthy system. In that situation, then you could say, well, yeah, maybe they're printing money and that could be inflationary, but they're throwing large amounts of cash at a very sick, unhealthy system. And that doesn't change the sick and unhealthy system. It can cause any number of temporary deviations, temporary impacts. And you can absolutely make the case that in the United States, the government spending is largely responsible for why the US CPI is so out of line with all of the other CPIs around the world, including Europe, because of that government infusion. But it's not stimulus. It's not a permanent change in the situation. It's merely a temporary measure to try to offset and alleviate some of the harmful impacts of a very sick economy. And that's really the lesson of Japan. The Japanese did huge, massive doses of government spending, a lot of which, especially after 1997, were directly infused into the real economy through a bunch of shadow budget agencies and things like that. And again, as I said, it didn't change the inflation situation. It wasn't money flowing through the economy. It was simply governments spinning their wheels, trying to figure out how to get out of a situation that's beyond their control.
But don't you think Japan is a special case if they have basically the worst demographics in the world? So an older population usually is hugely deflationary, and they basically could export all their inflation as they have a basically successful industry, and they were able to export the inflation throughout the world. And at the same time, so in the 90s, the whole world was growing. So the whole world was buying goods from Japan. So do you think that's not a special case?
No, I don't think that's the case. I think those are reverse engineering what happened in Japan so that they can avoid blaming the central bank and the central government, because neo-Keynesian economists believe that government spending is helpful, monetary policies are effective, and therefore if the results are lacking, we have to blame something else. Now, the demographic situation, the demographics didn't explain what the Japan's lost decade of the 1990s. Okay, people said it was demographics after it became clear that the government nor the central bank could change the situation. And if you look at any of the economic statistics in Japan, what you see is nothing to do with demographics and everything to do with that inflection in 1990. So you have an economy going gangbusters, and all of a sudden in 1990, growth just disappears. And it disappears in a way that no matter what the government does or the central bank does, and we're talking 30 years now, no matter what takes place in that situation, nothing changes the economic situation. Now, why is that important? What happened in 1990? What was it that we can pinpoint for that inflection? And the answer is obvious. It was a monetary event where the yen system simply broke down. You had asset bubble, not just a real estate, but really a bank bubble that crashed. And ever since then, the banking system has never been right. It has never gotten back to the situation it was in before, simply because it can't. There's no way to go back to that pre-bubble situation, which I'm describing it in this way because it should sound very familiar to people in the United States, Europe, and around the rest of the world. Let's take the same situation. We can say any number of statistics, US GDP, European GDP, industrial, whatever underlying economic account you want to use. Guess what you find? You find real good, robust, or at least legitimate economic growth up until around a specific point, then an inflection. And ever since that inflection point, there's been an inability to grow. Or do we want to blame demographics? Well, yeah, economists have done that too. But what was that specific inflection point? You see it in Europe, you see it in the United States, you see it all over the world. What was that inflection point? 2008. What happened in 2008? Well, it wasn't subprime mortgages. It was a breakdown in a global money system, the Euro-dollar shortage. That's the only way we can align all of these economies. Why is it that Europe and the US economy match up perfectly in this kind of a situation? They grow before 2008, but can't grow after 2008 because it's a breakdown in the global reserve system. It's not demographics. It's not anything else. It's not, productive deflation. It's not, the robots are taking our jobs. That's not what's going on here. We have a monetary impediment, and it's not the hyperinflationary kind. It's the deflationary kind.
So what do you expect for the future? So what's your scenario? Will we see a big depression or a big deflationary shock? So what's your thought on this?
We've already had the deflationary shock, and we've already been in sort of the depression. I mean, look, economic growth has been completely different. Even if people are not aware of it, they're simply not aware of it. The fact of the matter, as I just said, around the entire world, the economic situation changed. The rate of change in underlying economic growth contracted. Even though GDP is still rising in all of these places, it's not rising in the same rate or in the same way as we talked about earlier. It's not redistributing economic wealth to all parts of the economic system. It's been very narrowly construed because economic growth has been very much constrained by this Euro-dollar problem since 2008. So I would argue that we've already had the economic depression. We just don't know we're in it. And we don't know why it's being caused, because we're hyper-focused on the Fed's balance sheet or the ECB's balance sheet when we need to be hyper-focused on the shadow money system that we can't see. As I tell people all the time, it's not what you can see that matters. It's what you can't see that you must pay attention to. And the only way we can see what's going on in the monetary system, because there's no statistics, there's nobody watching out for it, is we have to pay attention to the marketplace. What are the markets telling us about what must be going on in the monetary system? And as I just talked about with the interest rate fallacy, when you see low interest rates, that's a deflation tight money signal. And that's what we've seen, not just recently, but for the last 14 years. It's been a consistent case of the market is telling you tight money, deflationary circumstances. So when you look at it from the perspective of 2021, we have this underlying deflationary depression type mechanics that have been in place for a long time. And yeah, consumer prices have risen recently, but the market is saying that this underlying structural secular money problem is still very much a problem. In fact, it may have gotten worse last year, as you would expect. I mean, when you have a deflationary problem already, and then you go into a COVID recession, things are not going to come out the other side really good. So everything around the world is telling us that we're still in the deflationary and maybe even worse deflationary structural position that we were in before we ever got to 2020.
So what's the end game here, Jeff? So if you worry about deflation or about a dollar shortage, should we print more dollars? What's the solution here? What do you expect for the coming decade or the coming 5 years? How is this all going to play out?
See, now you've described the problem that central bankers have, right? We have a real effective money problem, but central banks don't do money anymore, and they haven't for 50 years. So what do? How do we resolve that problem? We have an even bigger problem because none of us, nor the banks that operate in the Euro-Dollar system, can define money. So the easy answer sounds like, if we have a money problem, make more money. Yeah, print more money. When we don't know how to do that, nobody does. How do we get banks' balance sheets to expand again? And I think that's another misconception that's at work here too, causing a lot of confusion. Is a lot of people, because of QE, have been led to believe that this has been a golden age for banks. The banks are doing really well. Wall Street has had an enormously fun decade at the expense of everyone else. And that's not true either. If you look at bank balance sheets up until last year, they were shrinking, or they were at least growing in a slight manner that was very different from their pre-crisis era. This has been a decade of really bad banking. It's been very bad for banks. And that's part of the problem. What we're really talking about with the Eurodollar system is, because it's bank-centered, if banks aren't willing to grow their balance sheet, there will not be more money for the global economy, because the money comes from that bank balance sheet expansion. So what we're really talking about is, how do we get more money into the system? How do we get banks to expand their balance sheets again? And that's a really complicated topic where I don't think there are, Japanese example, I don't think there are any ways back to the way we used to do it before. Once the horses are out of the barn, you can't get them back in.
Yeah, I mean, I guess we need to send out the helicopters to drop some money on people. But
and even that comes up short. I mean, other than temporary effects, it doesn't actually change the underlying shape. So, the real answer here, if we're moving ourselves outside of the conventional topic and talking about, what really could happen, what we're really describing is, how do we rewrite the monetary world from the ground up? How do we go from a Euro-dollar system that hasn't worked in 14 years, setting aside the fact the public doesn't know about it, the public doesn't know that there's a deflationary problem in it. How do we rewrite the monetary system so that's not so inherently contradictory? For example, I mean, a lot of the ways that the Eurodollar system, when it was growing through the 80s, 90s, and 2000s, was just stupid, insane. You would never design a monetary system that prioritized growth over any kind of rational thought. Subprime mortgages weren't the problem in 2008, but they were very much a symptom of that problem. You don't want a monetary system where everybody says subprime mortgages are a good idea. We don't want to go back to the Eurodollar way of doing business, because that wasn't really a good way to do it either. So I think we want to look at the problem that actually exists and say, how do we solve it? It's by moving to a monetary system that's truly stable.
How would you create it? How would you create a different monetary system?
What is a stable monetary system in your opinion?
Well, a stable monetary system is one that prioritizes economic growth rather than financial growth. And that's one of the problems of the Euro-Dollar system, is that especially toward the end, it was almost financialization for the sake of financialization, regardless of whether there was any real economic impacts or not. So even the priorities of the Euro-Dollar system were backwards in a lot of ways. To me, stability is where you have the monetary system being nothing more than a tool for real economic processes to become as efficient as they possibly can. Because that's really what money is. And I think that's another misconception people have, is that money is wealth, or money equates to wealth. It doesn't. Money is a tool. That's all it is. It's a tool so that, complex financial or complex economic interactions can take place as efficiently and maximized as much as possible. That's really the role of the monetary system, is to grease the wheels of commerce and make sure the wheels of commerce can grow as fast and as far as possible. So we need to start, if we're designing a monetary system from scratch, we need to design a monetary system with that purpose in mind, and only that purpose in mind. How do we create a monetary system that reflects the real economic needs, not sort of tries to manage it or manipulate it? And that's really, stability is sort of a result of doing that correctly.
But do you think that's even possible? As long as humans are in control of the monetary system, it always will get corrupted. It might take 10 years, it might take 50 years. But even if we hit the reset button now, create the system you envision, 50 years from now, we're probably at the same point.
Our children and our grandchildren are having the same conversation, because we're having the same conversation that our grandparents did. You're right, history is secular. And so I'm not designing a monetary system to last to the end of time. I'm designing a monetary system with the idea of how can it be elastic and evolve with the times, so that maybe, yes, we do have this conversation 50 years from now, but it's not life or death. It's sort of like, hey, the monetary system, it's showing its age. Let's tweak and fine tune it and do something a little different. Not that every 50 years we have to scrap the damn thing because the world's falling apart and start from scratch. So what we're really trying to do is, as you're pointing out, Florian, I think you're pointing out very wisely, we need to keep in mind the limitations of our own imagination. What I just described was an ideal situation that has no hope whatsoever of ever being undertaken in the real world. That doesn't mean we shouldn't try to imitate or mimic or create the kind of conditions that at least, they do have some realistic chance of being stable and useful and efficient for as prolonged period of time as possible, recognizing that it's probably going to need some tweaks and fine tuning along the way, because you're right. Human nature always wishes to corrupt. Even the most virtuous thing that we can possibly create will be corrupted over time. And keeping that in mind and knowing that at the start, it's not like Bretton Woods in 1944, where we think we're creating the entire post-war era, not just the post-war era, but a monetary system for all eternity. We're not doing anything like that. We can't. So it's really, how do we get something that's workable for the foreseeable future, understanding and building into it the ability to change it as conditions warrant, which creates all sorts of opportunities to corrupt it.
Yeah. So let's summarize. So the system is broken. There is no solution within the system. The only thing the central banks do is like buying time. And we will get to a new monetary system. It will last another 1 or 2 generations. And then we have the same conversation again. If Elon Musk is right, we're still around and we live forever and can talk about it again. But how do you prepare for this scenario? How do you invest? How is Jeff Snider investing and diversifying his portfolio to protect his wealth?
Well, one of the things you do is, first of all, be honest with yourself about what's really going on. That's where you have to start understanding the risks involved. For example, if you want to buy stocks, there's nothing wrong with buying stocks, because stocks can be, they can go up, even though they're detached from any fundamental value, they can continue to rise for the foreseeable future, as they have over the last, decade and a half, completely detached from fundamentals. So yeah, if you understand what you're getting yourself into, there's any number of assets you can get involved with. So it's not a matter of, I have to protect myself for the world ending tomorrow. That's not what we're talking about here. In fact, if anything, the fact that we're talking about this broken Euro-dollar system after 14 years sort of gives you a sense of this thing really does have the ability to at least function minimally. And therefore, it doesn't mean it has to end in the near term. We can continue in this really bad, low growth, deflationary position for how many more years longer? I mean, again, the Japanese example is a good one. I know people want to dismiss Japan and say, well, those are just Japanese factors, but why is it that we continue to replicate both Japan's policies as well as its results? Because maybe Japan is not an isolated case. And so that's frightening in its own way, right? Because to me, the worst case scenario is that nothing changes, is that we continue to limp along in this this low growth paradigm.
Zombie economy, basically. So
that's a really, a zombie economy that nobody knows why it's a zombie economy, because then the risks are no longer economic and financial, they're political and social. We see the world break down, political extremism on both sides. I mean, if there's no answers coming to you from the anybody anywhere, you're going to start to seek out answers from anybody who claims to have them. And that's usually what extreme politicians definitely do. They seek out these kinds of situations where they say, I have the answer, and we're going to demonize the other people. And that's how we can blame, or that's how we can explain the situation we're in. So that to me is the worst case, that we continue along in this situation where we know we're not going to get growth. Inflation is essentially our signal that things are wrong. So we're going to continue that situation, but the public has no idea what's really going on. We can't provide any answers because central bankers are clueless. Politicians get their economic and monetary answers from central bankers. And so we don't examine the one thing that's wrong, right? The one thing that we've been told ever since 2008 not to look at is the monetary system. Don't worry about it. The Fed's done QE. You don't need to pay attention to what QE actually is. Just be happy that we've printed all this money. And that's the one thing that we're not supposed to look at that's actually wrong. So yeah, that's the biggest danger here.
But I mean, Jeff, it's coming. So actually, if you argue, the problem is people always get corrupted. So people shouldn't be in charge of the monetary system. So maybe we have a solution now. What about Bitcoin, Jeff? What are your thoughts on Bitcoin? Why not implement a Bitcoin standard and nobody's in control of the monetary system anymore? And we have a stable monetary system. So Bitcoin, there will only be 21 million Bitcoins until the end of time. So doesn't that sound like a good solution to you?
Yeah, there's two parts to what you just said. Let me take the first part, which is I'm not advocating for a top-down monetary system to take over the Euro-Dollar system. I'm actually advocating the opposite, which is what you just said. I want a private money system, and I would like to see, in this transition phase at least, a competition for a private money system. Let's have different forms of currency, battle it out to see which one works the best. And I think that's really what we're heading toward, as well as what ultimately will be the best kind of a solution. It's a situation that takes money out of the hands of not just the public sector, not just central bankers and politicians, but also takes money out of the hands of the big banks. That's the central problem I see with the Euro-Dollar system, is that privileged the largest banks. And it wasn't like the big banks said, hey, let's go take over the world. They were actually performing a global service at the time this happened. Go back to the 50s and 60s in Triffin's paradox. They actually solved Triffin's paradox at a time we needed them to. The world needed this kind of monetary situation to overcome that monetary implement so we could have globalized growth, which, I mean, globalization got sort of a dirty reputation, but you look around the rest of the world, I mean, miracle economic growth across emerging markets, that was a positive thing. The problem was that the system, as I said, was inherently unstable, and it rewarded the wrong actors doing bad things. So we don't, let's take money out of the hands of governments. Let's take money out of the hands of only a narrow slice of the largest banks, and let's decentralize it. Let's do that. And let's do it in a way that we're recognizing, first of all, why I don't really favor Bitcoin is because I don't think it's a dynamic enough situation or dynamic enough setup to meet the needs of a changing, evolving global economy. It's one of the things that the Euro-Dollar system did well because it was bank-centered. It could respond to changes in the economy. And yes, the argument is it responded in the wrong ways and did the wrong things. But history has shown you don't want a deflationary monetary situation to develop, which a fixed money system will always have that kind of a problem in it. So I would like to see sort of a loosey-goosey kind of Bitcoin where it's constrained, but it's not fixed. And the constraints are more about rules under which the situation evolves through time, rather than just saying here and now, making the mistake that John Maynard Keynes and Harry Dexter White did in 1944 when saying we're going to fix the monetary system in this way, and then within a decade we'll see how that doesn't work. So I think Bitcoin is too constraining, but I understand why. And I think it's a good way. It's a good first technology to explore going in the right direction.
Elon Musk was right with Dogecoin.
What's that?
Dogecoin. Elon Musk promoting Dogecoin because it's more flexible, no cap. So
see, I think there's a, again, it's being too idealistic, but there's a happy medium here. How do we go in between the absolute fixed and the absolute open? Yeah. And I think that's really where we're trying to target, understanding that we don't have a crystal ball. We can't see exactly into the future. So we need to have some flexibility, keep in mind flexibility when we're designing a monetary system, because we don't know how things will go. And we don't want the monetary system to be a drag, because as we said before, money is a tool to create economic efficiency, which is the secret to economic growth and progress. So if we already design a monetary system from scratch that we know in a couple of years is going to be a constraining factor, we've already failed. And human history has shown, the euro dollar itself was a response to monetary constraint. We're going to see if we design a future monetary system that is too constraining, then Bitcoin is going to surrender itself to the next Bitcoin. There's always going to be a desire to create money that has enough elasticity that allows sustainable, efficient economic growth. So ideally, in my mind anyway, I'd like to see something in between Bitcoin and the unlimited open-ended. Yeah, which is
let's call it Snider coin. But anyhow, you did not answer my question. I asked you before how to invest in those times. So how, for example, do you invest your money to protect yourself from the deflationary shock, perhaps, which is coming, or the deflation in general? So
put yourself in the shoes of our listeners, mostly retail or private investors. And if they hear about deflation, they probably think, okay, I should hold on to my cash. I shouldn't invest in commodities or stocks or real estate. So do you have any tips, any hints how to actually handle the current situation for a private investor?
Yeah, when you see deflationary potential go up, as we're seeing right now, for a retail investor, treasury bonds and things like that are going to be the best investment. I don't know about Germany, because the last thing you want to do is own a negative yielding Deutsche Bund. That's just all negative. That's for the banking system. That's not for retail investors. So you don't have that kind of option in Germany. But liquid bonds are one way to do it. Safe bonds, safe credits. Gold, maybe counterintuitively, is another. And I think there's misconceptions about gold as well. Gold is not an inflation hedge. In fact, it's a very poor inflation hedge. Well, gold as a hedge is against the biggest monetary errors, which out of control inflation like the 1970s was one. That is one form of major monetary error, as is a deflationary period. You look at what gold did really well in 2008, outside of volatility. It was very volatile for reasons we don't need to get into here. So it was very volatile in 2008, but it performed best from beginning to end. And think about gold over the last couple of years, going back to 2018, for example. Gold has done really well, even as deflationary potential has risen. Bond yields have fallen. And that's another factor in gold's favor. If you think interest rates are low and going lower and going to stay low, the opportunity cost of holding gold goes down to zero, because gold doesn't, the old argument, gold doesn't pay an interest rate, which is true. But if nobody else pays an interest rate anyway, then why not own gold? So gold is actually a very good deflation hedge, as it has been over the last almost 3 years now. So that's another way to protect yourself from rising deflationary potential. And there are other defensive measures that you can take within certain stocks, for example, in certain asset classes. And if you're a more sophisticated investor, you can get into things like Euro-Dollar futures and curve bets and things like. There's any number of ways to really maximize opportunity in any direction. So if you think that we're going into a larger deflationary period, there are ways to not just protect yourself, but actually take advantage of them.
Okay. Wow. Okay, this is totally different than the narrative in the German newspapers and media. So you expect deflation. That was very interesting, and I think the people will like it. I'm really curious about the comments beneath this video. So we've got two final questions. The first one is, what's the most important book you've read or you can recommend?
The most important book I read actually has nothing to do with euro dollars at all, or it's a monetary history written by Milton Friedman and Anna Schwartz in 1963. And the reason I think it's useful because they essentially did what we're doing now. They looked at the monetary textbook descriptions of the up to the Great Depression and said, we're missing something. There's something we're really missing here. We don't really know what happened in the Great Depression, and we need to take a serious look at how the monetary system evolved. I mean, today it sounds very quaint, a deposit, fractional reserve lending and deposit multipliers and that. When they wrote the book, that was kind of, open people's eyes to say bank money, that kind of thing. It was a way to explain the world and how it evolved up to that time. So to me, a monetary history was useful in defining the period before we got to this current age in many of the same ways as we're trying to take apart right now, even if we're another stage of evolution further along.
Okay. So, and the final question has nothing to do with deflation, inflation, or gold or Bitcoin. What is the meaning of life for Jeff Snider, besides learning German now?
The meaning of life. I've never been asked that before. So I've often been described, and I think correctly, as the world's most boring human, because I spend my time reading Federal Reserve transcripts and academic literature about obscure Japanese banks in the early 1970s and things like that. And so the meaning of life is I'm the most boring human that exists, so that you don't have to be. And that I'll just leave it at that.
I'm so glad I asked this question at the end, because if we would have started with it, everybody would okay, let's go to another channel.
Let's turn this thing off, right?
No, Jeff, I have to say, you're not boring at all. We will invite you again, and I think the people will just love you. And so you're not boring. Whoever told you this, he was so wrong.
Okay, thank you. Look, I think the message really is that, look, when you're just somebody paying attention, why are stocks going? You're asking yourself all these questions. Yeah. If you can open your mind just a little bit to say, maybe central banks don't do what they think, maybe QE isn't what I think it is, you just start asking questions. You don't need to take my word for it. Just start asking these questions and looking at the details. I think you'll do yourself a huge favor.
Yeah, we're coming back to you definitely, and then we see who was right. Is it inflation? Is it deflation? Hyperinflation? Will Bitcoin win the currency war or whatever? So there's so much to talk with you. Like Florian already said when we started. So where can find people more about you? So how can they follow you? Do you have a website, Twitter handle?
Yeah, they can find me on Twitter. It's Jeff Snider _AIP. I publish a lot of research and a lot of bits and pieces about the Euro-Dollar system history and what's going on in the current inflation, deflation, all that stuff at my company's website. It's alhambrapartners.com. And I also do a podcast with my co-host Emil Kalinowski. It's called Euro-Dollar University's Making Sense. And you can find that on YouTube or any podcast provider too.
Yeah, I can only highly recommend this podcast. I think most underrated macro content out there right now. So definitely check it out.
Yeah.
Thank you, guys.
We put the links beneath the videos, everything, Twitter and your website, of course. Have you ever been to the Alhambra in Spain?
I have not.
And then you name your company like this.
Well, that's the point. That's what we tell people, that it's named after the Moorish Fort in Spain, or Moorish Fort in Spain, but it's actually there is an Alhambra Avenue in Miami.
Disneyland.
Our first office was just happened to be there. But no. You'll have to cut that out of the video. It's the real Alhambra.
Okay. No, it was great talking to you, Jeff. It was great having you. We're definitely honored. Thank you for picking your mind. I think it was mind-blowing, and I think the people will just love it. Thank you very much.
Thank you.
My pleasure, guys.